Hello, everybody, and welcome back to another edition of the Forex Market Preview. If this is the first time that you're joining me, thank you so much. We're up to about 22,000 subscribers now on YouTube, which, if I'm not mistaken, does make us the largest collection of Forex traders assembled on one YouTube page anywhere. So I think we got the award for that now, and we've got a ton of stuff for you guys. If you're brand new and you're watching the Forex Market Preview and you want to learn more, there's everything from me trading live all the way to recorded seminars and live events that we've done that are all in the on the YouTube page. So feel free to take a look at that and spend as much time as you want. There's a wealth of knowledge to be learned just right here on the YouTube page. And if you are one of those 22,000 subscribers who watches this video every week, which is somewhere in the neighborhood of 6,000 people or so that tend to watch the video every week, then I want to welcome you guys back because we're going to talk about some really great stuff here this week. And I wanted to start out this morning. Let me just clean up this chart a little bit. I wanted to start out this morning kind of talking about a couple of different opportunities. You see this is a shot of the pound dollar chart, and the market is full of opportunity. Opportunity to trade based off of patterns, which we do a lot of here, based off of structure, which we do a lot of here, based off of indicators and oscillators and all kinds of different ways. There are a multitude of ways to make money trading in the Forex market. The question is, which one are you? And the most important piece is that you cannot be all things to all people, and you cannot be every kind of trader. And there are a lot especially for new traders. They say they might see a head and shoulders pattern, and I'll be talking about some structure resistance or something. They say, "But Jason, didn't you see the head and shoulders pattern there?" And I said, "Yes, I did see it." And they said, "Well, why didn't you trade that?" And I said, "Well, that's not part of my trading plan." And they say, "Well, yeah, but I mean, is it not? Why don't you trade head and shoulders patterns?" Because I can't trade everything. You see, just because I know what a head and shoulders pattern is doesn't mean that makes it into my trading plan. Just because I know what a MACD crossover system is doesn't mean that's something that I'll trade. And one of the most difficult parts about bringing a new trader on board and getting them into the mindset of trading professionally is that we really focus on, expertise, specialists in a sense, that we want to be very, very, very good at what we do, and we want to work in a very narrow arena. And if we do that, and we know that what we do is profitable, then we stand a very, very good chance of being successful. But when we try and spread ourselves too thin, when we try and be all things to all people, when we try to be all kinds of traders in all markets, that's when we end up blowing ourselves up and destroying trading accounts. And so what you see here, the majority of the time, is advanced pattern recognition and structure trading. Trend continuation, counter-trend style trading. That's what we do here. And we don't focus on fundamentals. I'm not saying that you can't make money on fundamentals. I just said I've just never met a retail trader who has. Like in real life, I got lots of guys who tell me that they do, but I've never actually met one that was producing profit trading off of fundamentals. I think it is very, very, very difficult. Nothing is impossible, but I think it is very, very, very difficult for you to trade based on fundamentals for two reasons. In order to trade off of fundamentals, you have to know two things. You have to be able to accurately predict two things with consistency. Number one, you have to be able to predict what the number is going to be. So if it's non-farm payrolls, if it's a PMI, if it's the rate decision, whatever the case may be, you have to be able to accurately predict what that number is going to be on a consistent basis over time. You don't have to be 100% right, but you have to consistently be on the number. The second thing that you have to predict correctly with consistency is how the market is going to react to that number. Now, if you think about it, those are in fact two things that you cannot possibly know. You can guess at them. You can do a lot of research. You can come to what you think is a reasonable expectation. But as a matter of course, there is no possible way for you to predict with a high degree of accuracy what that number is going to be. And secondly, and this is really the most important one, is that you have no idea how the market is going to react to that number. Is it going to have already priced it in? Is it going to skyrocket? Is it going to decline? How is it going to read that number? Because it has to do with a lot of socioeconomic conditions. And this is why we talk about all markets being psychologically driven. All right? Markets are not fundamentally driven, as some would believe it. They're 100% entirely psychologically driven. It is the fundamental data that causes the emotional reaction, which causes the move. It is not the fundamental information on its own that makes the move happen. It's the reaction from people in the news. And you see this all the time. When the market is very bullish and everything is going well, it doesn't matter how much bad news comes out, the market never really takes a decline. It just continues to rally and rally and rally and rally. Until all of a sudden, all heck breaks loose. We start to see parts of the pillars start to fall apart. And then all of a sudden, it doesn't matter what kind of good news comes out, you can't get the market to rally whatever you try and do. And this is the difference. It is not the fundamental data itself. It is how the market interprets that information. It is the psychology that matters. And when we look at a chart, what a chart tells us is it tells us the actions, the results of the actions that all market participants make. That's a writer downer. What we're talking about, what the chart shows us, is the result of all market participants' actions. Not what they say they're going to do, not what they think, but what they actually do. And you get to see out of that battle between buyer and seller who wins. And based on that, you can make some very, very accurate predictions about what the market is going to do next. And I'll give you an example here in just a minute. But let's take a look at the pound dollar here as we run up into this resistance level. Okay? Now, market has been trading up and up and up and up and up. I'm going to consolidate this chart up so you can see it. I mean, look at what the market's been doing here. Just nothing but a straight vertical move. And every single time the market breaks down, we get a rally. Breaks down, get a rally. Eventually, guys, this will end. We will see the retracement, as we always do. It's just a question of when. Are we going to see it at this double top? I don't know. But if you are looking to build a case for entry, you're finding the market coming up into previous structure resistance. The market was beaten back on that, on pound dollar on Friday. This is potentially a decent shorting opportunity. Opportunity to get short on a counter trend trade. Remember, counter trend. So what are we looking for? We're looking for maybe a one-day decline, a two-day decline, back down into 68.97s. Maybe we can get a move all the way down into 67.50s or 6700s as the market continues to stay in this channel. But we have to be careful because this is a counter trend trading opportunity. But it gives you an example of exactly a point where the market might come into an area of consolidation and a place to short the market for a short-term gain. Now, also in here, we happen to have a pattern formation. Don't know if you guys recognize it or not. Some of you guys are very in tune with this. Some of you guys are very good. Some not so much. But there is a very nice bat pattern in here. Opportunity to sell on Friday, and we're right there now. This gives us a little added confirmation that we could potentially be seeing the market retrace like this. Now, as you guys know, if you've been following me for any length of time, we've actually built pattern software for this. And you can see that bat pattern coming in right there. Right? Market came in, 169.60s was the sell. And the market trading at about that level right now. Now, this is the really nice thing that this software has allowed us to do that we've never been able to do before. We have been able to look back over 5 years based on the rules that we use. And for anybody who hasn't been through the course, the rules that we use for pattern trading are very specific. It's not, well, it has to come in between the 382 and the 786 on this leg. No, they're very, very, very specific rules, which is why we can get an accuracy level that's typically 50% higher than anything else we've tested. It's because rules matter. And we wrote the pattern software to specifically look for patterns according to our rule set. And then we looked back 5 years, which is something we've never been able to do before, on multiple time frames using 10 different pairs to figure out what the accuracy of these particular patterns are going to be. And they're right at 60%, give or take. Some are a little bit more, some are a little bit less, based on the pair that you're trading and the time frame you're trading. But you've got a pattern here that pays off 6 out of every 10 times. And now we're at an area where the pattern is saying sell. And if we decide to go ahead and sell these right here, then what we're going to look for, if I bring in my Fibonacci retracement tool, is we're going to be looking for a press back down into 68.77s, look left. We talked about that previous structure level as the initial level. So just below that's that 382, 68.77 for our first target, and then potentially a little bit lower, around 168 for our secondary target. So again, we're not looking for a huge move here, guys. We're not looking for a total reversal of the pound dollar trade. All we're looking for is a little bit of give. Just a little bit of a decline where we can pick up and pick off a little bit of profit out of this market. And whether you're basing it off of a structure play right here, right, and saying, okay, I've got a double top, I've got some bearish divergence looking at my RSI. Look down here. Oops. Got a little bearish divergence on my RSI. Or whether you're choosing to go with the pattern recognition and saying, yes, I also have a bat pattern here and I'm going to sell it here, there's an opportunity to trade. Let's take a look at some other ones. We talked about this one last week, Euro Yen. Had a couple of trading opportunities here. First was the cipher pattern. We didn't quite get filled last week. Well, this week we came down, boom, got filled. Market's trading higher. We're actually in the money just a hair on that position. A little bit lower than that, we actually have a bat pattern here at 37 even handle. But that's about, I say a little lower. It's 80 pips lower. So, again, same rules apply here. We're going to look for a retracement here into the 382, followed by the 618. I would imagine if I bring in my tool set here that we're going to see, look, that 382 coming in right against structure. Right there. It is amazing how often Fibonacci lines up with structure. Look left, you've also got structure here. You can see the support, resistance, right? All along that line. It's going to be a good place when the market rallies to look at taking those initial targets off at and then giving us a risk-free trade. The only other ones we've got that I looked at today was Aussie Yen, which hasn't quite rolled over yet, and then you've also got a Pound New Zealand trade here down in the bottom left-hand corner that's got a ways to go. We're not going to get there next week, and we may end up going lower and breaking structure to the downside. So not a lot there that I'm worried about, but you've got two great trades here that are sitting right on their entry points going into next week where you could have a nice return out of those. Let's take a look at... Was it Aussie Yen? There's a couple of... The yen pairs are all kind of lining up here. Let's just start with Pound Yen. I don't know what's going to happen here. I finally exited my Canada Yen trade. I got out for basically 7 pips of profit after holding it for 4 days or 5 days, and I just said enough is enough. But you've got this little wedge that's been setting up here on Pound Yen. This thing is coiling. You know, if you think of this like a coil... It's just getting tighter and tighter and tighter. This thing's going to break out one way or the other. I just don't know which way it is. Euro Yen. Euro Yen's already broken out to the downside here. Yeah, look at the structure level. Yeah, let's just do it like this. Okay. Actually made money on this trade on Friday. The market had come in, had made its full move for the day, or what I anticipated was the full move, ended up shorting, boom, back down. About 20 pips was what I caught out of this market. Now, guys, that's in a day trade. This is something else that you have to consider. We're going to go a little bit long today, but this is important stuff. Average true range, all right? The average true range of this market right now is 75 pips. That's it. Average true range of the Euro USD, 63. It wasn't a few days ago, the average true range was less than 50 pips. Guys, this is, for those of you who have not been trading very long, we have not seen this lack of volatility in over a decade. Now think back a decade. It's 2014. That we're talking 2002, 2003 time frame. This was before internet trading for Forex was really even an idea. I mean, there was especially not for retail trading. This was really pre FX trading. Okay? We have not seen volatility this low since we were there. If you take a look at the VIX, we talked about it. This is for stocks, but let's just take a look at stocks. Okay? VIX is trading at 12. Let's consolidate this chart up. When was the last time we were down here? Well, these all-time lows were back in March. And if we look back even further, look, it's just like we got to go all the way back to 2006, right? During the height of the real estate boom, when everybody, the world was perfect and everybody had low rates and was refinancing and, it was just the greatest of times. That was the last time volatility was that low. Total complacency. Now, what does that mean for us as traders? Well, it means that things are going to get very, very difficult if you're day trading. We've gone from, normally taking 5 to 25 trades in our live system trading room with the Liberator, with the level 2 strategy, to trading 2 trades a day or 1 trade a day. It's just dead. We cannot make money if the market doesn't move. And we can control a lot of things as traders. We can control the style of trading. We can control... we can make adjustments to trading strategies when certain things aren't working. What we cannot do is we cannot fix something. If you've got a trend following strategy, you cannot make that trend following strategy make money if the market doesn't trend. If it doesn't move, you can't make money. And what we're seeing across everything, stocks, Forex, futures, is that everything's coiling. Nothing is moving. And it's just going to take some time before we're in a position where we're going to see a return to more normal volatility. But people who haven't been trading very long ask me, they say, well, Jason, is it ever going to go back? Do you think we'll ever see volatility again? Of course we will. But this is a time, this is a unique time in history, just like 2009 was a unique time in history. And we're lucky enough to get to be involved with that and to get to see that, to have that historical perspective as part of our trading background and our trading history, to know what it was like, to be able to remember 3, 4, 5 years from now, you're going to remember and you're going to say, remember back when volatility died out and we were, fighting and scrapping to try and make a living? Boy, I'm glad those days are gone. I'm reaching back now to 2008, 2009, 2007 and saying, hey, Euro USD, we're looking at on Euro Yen, average true range 75 pips. You want to know what it was in 2009? 300. Average of 300 pips a day. How hard do you think it was to capture 20 pips out of a market that moved 300 pips a day on average? Right? It is much more difficult to get 20 pips out of a market that only moves 50 a day. If you can survive this, you're going to thrive when the market finally decides to move again, when we finally start to see the expansion phase. Remember, markets go up, they go down, they go sideways. Trending leads to consolidation, and consolidation leads to expansion, right? We're in the consolidation phase right now. And when we break out into that expansion phase, the money is going to be cheap and easy. Right now, it's a struggle. But it's all part of the game. It's all part of trading. So don't get your head down about it. Don't be frustrated about it. Just understand what's happening. Be aware. And it'll take you a long way. Well, that's going to do it for this week, guys. I could go through some more charts, but I felt like there was it was better to spend some time talking about that area of volatility, and then also talking a little bit about the different ways that you can get involved in the market, be it structurally or using pattern recognition like we talked about. Now, if you like this video, please hit that like button, share it with a friend, help me spread the word about what we're doing here, and don't forget to, well, I don't know, I guess that's it. So I'll see you guys back here next week. Until then, good luck, good trading. I'll talk to you soon.